Perfect. I'll quickly actually do a sort of not revision, sort of like on what we have discussed yesterday. Um, so we studied what is forwards. We taken this Goldsmith example. We said like forwards are not standardized. That's why future markets are come into the picture. And then like within futures, what we have done is futures bring in the standardization, which is the most important and interesting concept, which is what the exam likes. As I said, right, exchange traded standard contract terms, that are available there. And then the most important part, very, very important part, I think without that, there is no exam there. The clearing, settlement mechanism is one of the key important feature in the, futures market. Okay. So the settlement, is done by CDSL and NSDL, in the Indian market. That is a very key feature of the futures market. Okay. And then, as I mentioned, like, futures are all the forward promise. It's not like, you're either exchanging money or you're actually taking the quantity today. You are getting into a contract. Always remember these are all contracts. Okay. So that's why derivative contracts, currency contracts, interest rate contracts, right? You are entering into a contract with a promise that you will be paying the entire amount and as well as taking the position of the quantity at a later date. Okay, so that's what the futures are all about. Okay. Now, very quickly, then what next? We spoke about the future contract available in the Indian market, 3 months, this month, next month, and the month later, 3 months, which is again a standard question there. We spoke about expiry logic, Tuesday, NSE, BSE, Thursdays. And then like sorry, that's for options. For futures, it's every last Tuesday of every month. Okay, is when the futures get expired. Okay, tick size is where the minimum movement that is allowed for price movement. Especially in the case of equity. Please mute yourself. Thanks. In the case of equity, it is actually 5 paisa. We'll study currency derivatives, and we will see what is the minimum tick size there. Bid again. Yeah, I'm muting. Thanks, guys. Sorry. When you log in, please kindly mute yourself. Thank you so much. Okay. Bid is when like the buyer, what the buyer is willing to buy, and ask is what will seller is selling to sell. Sorry, what the seller is willing to sell. Obviously, the price there, right? Okay, so that's what we have discussed yesterday, right? Now we will get into a little bit, some interesting important concepts today. Let me go here to it. Okay, let me go back to my. Sorry, guys. If you're not speaking, please kindly. Okay. This is a very interesting question, which NISM really, really likes. And I think, again, this is very, very, important question as well, right? There is this concept of basis. Okay. What is basis? The basis is the difference between, there is two concepts that we are introducing here. One is called a spot price and another one is called futures price. Okay. Rather than just talking, let me show it quickly. Okay, because we are looking to learn little in a practical way. Okay, so let's go back to Reliance, right? So what is the Reliance today's price? Reliance today's price is 1279.80. If you see that on the screen, right? So what is that? That is actually called spot price. Okay, what is that? Reliance is actually the cash component here. Let me quickly open this. This is cash, right? I'm buying it in cash. This is actually called as spot price. Okay. Now, what is the future price of Reliance? What is the future price of Reliance? The future price of Reliance is 1283.60. Got it? Two things. What is the spot price? The price, the cash price at which that particular stock is trading on the particular day, particular moment, etc. and all. The future price is where the future contract is trading for the particular index, stock, etc. It is called futures price. Okay. Now, the basis is the difference between the spot price and futures price, okay, which is 1279.80 minus 1283.60. Got it? Now, that is one concept which you have to keep in mind, which is very, very important. Now, the interesting component is, what we have mentioned is, every contract has an expiry, right? Similar to goldsmith example, like, after 1 month, you have to go to the goldsmith and get your gold. That's it, no other questions asked. Similarly, when you are trading this July month, contract, that has an expiry. Okay. When does that expiry? Last Tuesday, that we have discussed, right? Please, listen to this carefully. On the expiry day, the spot price and futures price come together. Okay, I'm repeating it. On the expiry day, the spot price and the expiry price come together, and the basis, which is the difference between spot price and future price on expiry day, is always zero, which is one of the very favorite question again, for this exam. Okay. Two concepts here. Base price is the difference between spot price and the futures price, which I have shown you on the live market. The most important other question is, on an expiry day, the basis can be positive or negative. In this instance, what we have seen is it is actually negative, right? But on an expiry day, the basis is always zero. Okay. The cash component, that spot price and the future price, converts to it. Okay. Let's not get into the details there, how it happens, etc. and all. That, like, once you clear the exam, that we conduct multiple sessions for distributors, then we will discuss in detail. Then we will become all fund managers. But for the exam perspective, this is what you need to know. Clear, everyone? Cool. Okay. Let's get into the next concept. Okay. Then let's get into the next concept here. Primarily, the cost of carry. It's not that much of an important thing, but just understand this. What is cost of carry, right? So primarily, right, going back to our, the gold example there, right? What am I saying, right? I'm actually going to buy the gold after a month's time. Okay. And I'm not taking the delivery of the gold. So what does it mean? So now the goldsmith actually has to carry the gold, which means there is a carrying cost that is associated to the goldsmith or the gold shop owner. Plus, in case if there is any insurance on the top of it, etc., and all, they have to bear with it, because I am not buying the gold today and I'm buying the gold only after a month's time. Okay. So the cost of carry concept, the future price is determined by what is the spot price today plus cost of carry. Cost of carry is nothing but whatever the charges that are associated in holding that particular instrument. Okay. Again, don't go too deep. Just remember this for now. That is more than sufficient. I think if you want the cost of carry, you can actually correlate with the gold example that we just now discussed. Okay. Now, okay, let's quickly move on. I want to touch base on, this is the most important concept. Margins, we have discussed this. Okay. This is another one, MTM, which is again a very important, concept, and which is a very, very favorite question for, the exam. So yesterday we discussed who pays the margin. Both the buyer and seller pays the margin, right? Which is what we have seen on the screen as well yesterday, right? So for example, like, I am buying it, I am paying the margin here. If you see 1,13,000 here. Similarly, if I am selling it, I am also paying the margin. Okay, just revising that. Now, what happens is, say for example, if I am buying the future contract today, I need not hold it until the 1 month, right? For example, if the Reliance have gone up like 10 points, 20 points, 30 points, 40 points in next 1 week, I want to book profits, on that particular day itself. I need not wait until the expiry of the contract. Okay. So when I'm selling it, the exchange, has to settle down on my profits and have to transfer it to my account. Whatever the profits I'm making, have to transfer it to my account. It's as simple as that. Okay. That concept is called mark to market settlement. Okay. What does mark to market MTM stands for? Profits and losses, on futures are settled on a day-to-day basis. Okay. It's not that, I am buying today and then if I'm selling tomorrow, I'm not waiting until the end of the month for that money to come into my account. Okay, it's as simple as that. So every day there is a settlement, in the futures contract, which is actually the whatever the profits, losses, whatever I'm doing, which is what is called as, the concept is called mark to, market, settlement is the concept there. Okay. This again a very, 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 famous question, right? That like these guys wanted to ask. Okay. So we learned three concepts here: basis and mark to market, two concepts, and the basis becomes zero on the expiry day. Please note, if you want to make a note also, you can make a note. Okay. Now, this is what I wanted to spend in a little bit of a time here, open interest, right? How many of you know open interest as a concept? It's little tricky, but we will try to study only which is required, for the um uh, so okay, let me quickly open, this one here. Primarily, what is stock market? Stock market is when we teach, I do take trading classes, and when we teach, right, stock market is nothing but a fight between two parties, right? There is a bid and there is an ask. Okay, a bid and ask has to exist, to actually for a transaction to happen. It's as simple as that, right? You are buying, someone is selling, you are buying. Okay, there has to be two parties involved, for you to create a transaction. It's as simple as that way. Okay. Similarly, in futures, if there is a concept called open interest. What is an open interest? The number of contracts that are open at a certain point of time. Okay. That means these contracts are not settled, okay, on that particular day. Okay. It's not at closed, right? They are open contracts. Now, one interesting concept is in open interest. Please listen to this carefully. Open interest, if there is a long position and there is a short position, right? One long plus one short position becomes one open, interest. I'm repeating it. One long plus one short equals to one open interest. One long and one short is not equal to two open interests. Getting it? Hope I'm not confused. Primarily, what I'm saying is we are combining the bid and ask, of the particular transaction, and then we are counting that as one open interest. Okay. So here in this case, what is happening, if you see the call side, the OI is 4. That means there is a long position and there is a short position, so there are 4 positions that are open like that. Ideally 8, but there is 4 longs, 4 shorts that are open on this side. Similarly, on the put side, what is happening here? If you see the 39,090 contract, that means there are, respective longs and respective shorts that are open on this particular side as well. Okay, don't get into too much of details. We'll study this little bit more in detail when we are talking about options, because in options, this concept is pretty much interesting concept. For now, just understand the concept that long is a buy position, short is a sell position, and open position is a mix of long and short. One long and short is what is called as open contract. Got it, guys? Any questions on this? Maybe let me take a quick pause here because this is little complex. Not
Yeah,
complex per se.
I already in the chart box I mentioned that one. What is the difference between the volume and open interest numbers? And second thing is actually for
Sir,
future.
please. When I focus on one particular topic, please stick on to that. I will focus on OI change, volume, etc. and all. Please don't go into different directions. Okay. I will cover everything in options. When I'm going, when I'm talking about open interest, let's focus only on open interest, please.
Yeah, at the same time, the futures open interest is entirely different. This is you are saying that on options open interest, futures open interest is going to be NSE spot is the column that is where you can get the futures
Sir,
open
I just
interest.
showed you the example. Okay, I just showed you the example of OA. That's it.
MPM can explain one more time.
Sorry, what was the question?
Can I just repeat one time? I just
Can't hear anything actually.
So MTM you have explained, right? Can you explain one more time?
Okay, MTM is right. Say for example, if you are buying a Reliance contract today, and if you made profit tomorrow, right? And if you sold the contract, what does MTM stand for? There is a daily settlement of both gains and losses on every on whatever the squared of contracts every day. Okay, if you close, okay, let me talk in plain English terms, right?
Okay.
Today I bought Reliance futures contract. Tomorrow I made profit and I close the position. Okay. I need not wait until the end of the month for my money to come into my bank account. Okay. I am actually the settlement will happen on that day itself, and I will see the money in my account day after tomorrow. Okay. T+1 is the settlement. Got it? Okay.
Mr. Kiran, can you do me a favor? Can you please put your slide on slide show mode? Actually, we are not able to view properly. I'm sorry, I'm disturbing you.
No, that's okay. I'm doing multitasking here. I don't know. And also kind request, guys, I will cover every topic, so don't worry about that.
Yeah, you can in the WordPad that you can go for the last option. It will be giving you the full screen actually.
Yeah. Anyway, is this good now?
Much better, much better. Thanks.
Okay, perfect. Let's move on. And see, this is another interesting question. That the exam likes to test, and this is very important. Because uh, in options, the profit in some strategies, the profit is limited, the loss is unlimited. In some strategies, profit is unlimited, the loss is limited. So options, the what is the profit that you can generate actually vary. Okay, but in the case of the futures, what happens is either the profit is unlimited or the loss is unlimited. Okay, so it's as simple as that. Just remember, in futures, either the profit is unlimited or the loss is unlimited. Guys, please mute yourself. Yeah, thanks. Okay, now I will come to this a little bit more in a bit. Now I want to touch base. This is again. See, I'm going by what the exam focuses on, right? These are all the questions that you will see. In fact, if you're able to understand yesterday and today, you will be able to answer at least 10 to 12 questions. And these are all simple concepts only. It's not jargon. We will talk about numericals, as we go along. Okay. Now, in futures, especially, is a very important concept, and the exam likes a lot. At least there will be 1 to 2 questions on this. There are 3 market participants, which you have to, understand. Okay. Who are the first market participant? They are called hedgers. Okay. What is hedging? I have one position. In fact, say for example, if I bought Infosys, okay, I actually took Infosys long position. And if I feel that, Infosys might come down, or if I feel that I have to protect the position of Infosys, I will take another position which is sort of selling my index options or something else. Okay. Again, not getting into technicalities there. So I will, in a nutshell, remember that, for one particular, position, you are actually taking an opposite position, which is actually called as hedging. Okay. Hedge itself means that, right? You are actually mitigating your risk. Okay. Now, the typical mutual funds, whatever the mutual funds that we are distributing, etc., and all, they can only do hedging at this point of time. Okay. Now, banks, institutions, companies, all these guys do, hedging primarily, right? Now, who are the second participants in the market, especially in the futures market? They are retail participants, people like us. Okay. There are 2 important questions that come through. Retail participants, as we enter into the market, as I buy in more and more options or sell options, I am adding liquidity to the market. What is liquidity? I am bringing in more volume, more positions on that volume, is what I am actually bringing to the market. Okay. Now, the very interesting point also to be noted here is that the speculators or traders are risk takers. This is a very, very important point to be noted, and this is a very again what I mean is a favorite question there, right? They say, right, the retail participants or speculators are risk takers. Okay, we are all actually risk takers. Okay, now there are third participant in the market who are called arbitrageurs. Okay, what is an arbitrage? You actually, either for the same, for example, if there is Reliance, I'm just taking an example, like, don't go too much and analyzing this. Okay, by the way. So, for example, like, there is a Reliance price on NSEs, 1215, and on the BSE, the Reliance price is, say, for example, like 1215.4. Okay, now there is no exchange arbitrage that is available there, but like what happens is I can actually buy it here on one exchange, and since there is little bit of a difference in the price, right, and I will sell it on other exchange. Okay, that is called arbitrage. What is arbitrage? They look for mispricing, buy where the product is cheaper and sell where the product is higher, dearer. Okay, subject to cost and execution risk. Arbitrage is a very interesting concept. This is mostly done by high frequency traders and like the guys who can execute it very quickly. Okay, so three main participants: hedgers, the retail guys, and as well as arbitrage guys are the three main participants. And this you have to, you need not study too much about that. You remember these points and you will be able to answer at least 1 to 2 questions there. Okay, sorry. Okay, quickly then let's move on. Before I come to this, okay. So this is a very interesting concept which we have to learn. We will talk about calendar spreads just in a bit, right? So now when you take a futures position there, right? We spoke about hedging. What is hedging? I have one Infosys position, and respective to that, I am taking another position which is called as hedging. The typical mutual funds are all like the SEBI allows only the hedging opportunities for them. Naked position, right? This is a very important concept because the whole SIF as an asset class actually came into the picture because of naked shorting. Okay, what is a naked position? So, for example, like if I feel that IT is going down, or say for example, if I feel that Infosys will go down for the next 1 month, okay, what I will do is I will go and blindly short Infosys. Okay, or if you feel for example, like if there is other sector, something like Titan will go up for the next 1 month because the results have been extremely good. Okay, I will go and actually buy the futures position in Titan. Okay, now please be noted, when I'm shorting Infosys in the first instance, or when I'm going long in Titan, I don't have any other positions. Got it? What I mean by that, I will either completely only short Infosys. I will not have any other position to mitigate my risk. Okay. In the second instance, I will just go buy Titan long, and I will not put any other position to mitigate my risk. If the Titan comes down, like I'm at loss. That's there, right? If Infosys is not going down, it wants to go up, like I'm at loss. Okay. So naked position means there will be only one position. There will not be any corresponding position. Okay. What SIF, SEBI has allowed, especially for SIF, that is why they are asking us to study all this, stuff is in SIF, right? The SEBI has allowed 25% naked shorting opportunities, for the funds. Okay. So, for example, if there is a fund manager who believes that like IT will go down, they can go and blindly short the index or the companies without having a corresponding position. This is not possible in the existing mutual funds. All the mutual funds have to do hedging positions only. Okay, the naked positions are not available in the traditional mutual funds. Naked positions are available in SI. Got it? So simple thing, there is no underlying there is no other position that is there. There is only one position, that is called as naked position. Got it? Now uh, okay. there is this concept of calendar spread, which is again an interesting concept here. What is actually calendar spread? Let me quickly open my this one. Just give me a second, guys. I have to. See, the word itself means that, right? The word itself says in a calendar spread. Okay. What is calendar spread? Just understand this. Okay. So I generally take contracts in different months primarily. Okay. Calendar, right? Calendar and spread. Okay. The word itself says that, for example, I am taking 3 contracts, something like short in 1 month. Okay. And then 2 contracts long in second month. For example, the first month is July, second month is August. And then I'm taking 3 contracts long in third month. Okay. So what is calendar spread? I am actually taking the future contract, in the multiple month time frames. Okay. In the near month series. Okay. First month, second month, third month. Okay. Now, this is one interesting question that comes here. Let me do here, right? Okay, sorry, those are like this ones. Now calendar spread is 3 contracts versus, sorry, my first month 2 short contracts in first month, 2 contracts in second month. This is called one calendar spread. Got it? I am actually creating the spread between first month and second month between my contract. Similarly, I am creating the contract between first month and third month. Okay, first month and third month for my contracts. Understood here? Primarily, right, see, go back to Reliance, right? I'm taking, 3 future contracts this month. Say 2 future contracts in the month of, August, and another say 2 contracts in the month of September. The calendar spread is I'm matching these contracts so that I'm maximizing the profit and minimizing the loss. Okay. Again, don't get into the technicalities. We'll study in detail in options there. Okay. Here, the 2 concepts that I want you to just remember is calendar spread is between the months, point number 1. And so, for example, in the first instance, if my contract of the first month gets over, right? This contract, gets over. Okay. In this instance, right? What did I do here? I have created a calendar spread here, right? Calendar spread, what actually happened, I have contracts in my first month and I have contracts in my second month. I have combined that together and I have created a position. Okay. Now, there is a July expiry that got happened, right? When the July expiry happens, what is going to happen? This contract will get expired, right? My first month contracts all will get expired, right? Agree with me, everyone? For example, like July expiry, the contracts gets expired. Okay. Then what will be left with in the calendar spread? The calendar spread will have only 2 contracts of August. You're getting it, right? So I have taken 2 contracts in July. So for example, 2 contracts in August. I have created a calendar spread. Now, at the end of the expiry in the month of the July, that those 2 contracts got expired. What will be I left with? I will be left with only the 2 contracts of August. Okay. Now, what is this position? This is a very, very important question, and without this, again, there is no answer. Okay. This contract has actually become a naked position. Right? Naked position, which is what we discussed. what is exactly has happened before? We have two positions, but one position got squared off completely. So what is left? There is only August month, and it is actually called naked position. This is a very very interesting question again that the exam likes. Got it, everyone, on the concept here? Calendar spreads, and then when the near month contract, when that month contract gets over, the next, sorry, when there are two positions, when the first contract gets over, the second contract will become a naked position by expiry. Okay, we'll take questions on this. Don't worry. I wanted to cover decent stuff. Okay. Now moving on. We covered this part, hedges, speculators, and arbitrageurs. And then, we covered calendar spread, naked position. Again, this very, very interesting concept here.
Kiran, I think, sorry, calendar spread is not clear to few of us. Really.
Okay, don't worry. This is only from the exam perspective. Okay,
Yeah.
only from the exam perspective. I will repeat that. Let me quickly go through the concepts. Okay. So, okay, how many did not understand calendar spread? We just have to repeat that.
Question on calendar spread.
Yeah.
So you said that there are two contracts for this month and two contracts for next month. So calendar is only for this contract or for the annual contract?
I can't hear anything. Your voice is very cracky. I mean, the line is not clear.
Calendar spread is two contracts for this month, two contracts for next month. Two contracts for this month, two contracts for next month. Is that the calendar spread still works or it's a different one?
Okay, guys, just listen to this, right? See, I'm creating say two contracts this month. Okay, in the month of July, and then say two contracts for the month of August, and then I'm creating a spread. Okay, again we'll discuss in detail about on the options, on how to do this, because we have to study a little bit on the butterfly and other strategies there. Whenever options come, which will quickly start next week. Just for now, just understand the concept here, right? For Reliance, I have created two contracts. Okay, in the month of July. For August, I have created two contracts, and between those two, I have created a calendar spread. Okay, it's as simple as that. Okay, what is that again? Don't get into the details for now. Okay, the whole point that I'm trying to allude to here is when my July month, contracts get expired, at the end of the month. Okay, I will be left only with my August month contracts. In the first example, this calendar spread, when my July month contracts get expired, my August month contracts will become a naked position. That's it. As simple as that. For now, just only understand this part. Okay, clear, everyone?
Yes, sir, got it.
Okay. Okay. Let's quickly move on. I wanted to quickly touch on currency as well today. Because we will not be able to cover. The promise is to do this in 21 days. Okay. See, this is a very standard question. I think you might have done this in mutual fund exams, etc. and all, right? Systematic risk, unsystematic risk. Unsystematic risk is company specific or industry related, which can be completely eliminated by diversification. Systematic risk is market risk. For example, like Trump comes and talks, no one has control on whatever he does, right? That is called a systematic risk. Those risks are only hedged. Okay, we cannot actually diversify. Okay, it's as simple as that. These are very standard, that you generally write in the typical mutual fund exams as well. Okay, this I won't get into the details. Okay, again, long hedge, short hedge, spread position, we discussed that. Naked position, we discussed that. Okay. Okay. Quickly, let me take a quick 1-2 minute pause here. Before I start currency. Any questions on whatever? I will just quickly recap whatever we have discussed, right? Which is completely relevant for the exam. Forwards, are not standardized. That's why futures has come into the picture. futures or exchange comes into picture. There is a settlement mechanism in the futures. There is a contract. There is a futures contract that is there. There is a bid and there is an ask, buyer and seller. How do you determine the value of the contract? The quantity times the value of the the price of the contract at that particular time is your future contract value. Then for the participants in the futures market, we have hedgers, we have people like us, traders, and we have arbitrageurs. We have covered systematic risk, unsystematic risk. There are 3 calendar months that are available for you. July, August, September, this month, next month, the later month. The tick size in equity is 5 paisa. That means like the minimum movement that is allowed in each and every ticker. I mean every stock price there is 5 paisa in equity. And then we've discussed about calendar spread, naked positions. No hedging, only one position. Hedging, there is a respective position there. Calendar spread, again, the near bump when it expires, it becomes a naked position. Okay, so these are the concepts that you have to keep a track for, sort of chapter 3 equity derivatives, which is sort of like, if you give the equity derivatives exam, this is actually close to 20 marks, but you can expect at least 5 to 6 or 6 to 7 questions from whatever we have discussed so far. Okay. Okay. Let me quickly go through currency and then last 5-10 minutes or post 9 we will take questions. But before that, see, currency derivatives is also exactly the ditto same of what we have discussed, right? In the futures, contract value, etc. and all. But I wanted to sort of understand 2 important concepts in the currency derivatives, right? Okay. Now, in the equity derivatives, we are actually trading either an index, which is Bank Nifty, or the stocks, right? If the F&O is available in the market, we are actually trading the futures in those particular stocks in the Indian market, right? Now, how do we trade currency, right? What is the currency derivative is all about, right? To start with, let me quickly go back to my, screen here. So, or might be I'll explain here, right? So always we, refer USD INR, right? USD INR, USD INR, and USD INR. Okay. Okay. What does this actually refer to? Might be you can put it in the chat. What does this actually refer to? Not a this is exchange rate, right? No. Yes, exactly. Someone said base and quotation. Okay. Primarily, what is 1 USD equals to how many rupees? Primarily, right? That is what the USD INR actually stands for. So in the USD INR, USD, please note, this is actually the base currency, and INR is the quotation currency. Okay, let me quickly show you. Again, we'll quickly try to do the practical stuff only, right? If you see here, right? See, USD INR, this is pound INR, N is little tricky, but we will see that. Primarily, what does USD INR stand for? USD is the base currency. That's the base currency. INR is always the, the first currency is the base currency and the second currency is the quotation currency for you. Okay, from the jargon, because you need to understand this jargon. Okay. Now, for what is $1 equals to how many rupees for me? It's in simple English terms. $1 equals to how many rupees for me? Equals to 95.37 rupees. Okay, got it, right? So similarly, what is 1 pound? GBP stands for 1, pound, right? What is 1 pound equals to for me? 1 pound equals to 127.85 rupees pound. Okay. Now, here is a little tricky part. The only tricky part with JPY, is JPY is actually benchmarked against 100N, okay, not 1N. In the case of USD, please, listen to this. In the case of USD INR, the base is 1 USD. In the case of pound INR, the base is 1 pound. But in the case of JPY INR, the base for Japanese yen is 100. Okay. What are we saying here? 100N equals to 0.5877. Got it? Don't worry about that. We will repeat and we will do multiple things. But for now, understand when we are talking about JPY INR, it is always against 100 yen, not 1 yen. Okay. Quickly, let's get into this part here. So this is what we discussed just now. The base currency is, the first pair is the base currency. The second pair is the quotation currency. So USD by INR is what is the price of one, USD expressed in INR. Similarly, 1 pound expressed in, okay, GBP by USD is like, 1 pound expressed in USD. Okay. Now, the most important part here, please note, the statement below. Currency futures in India are regulated both by RBI and SEBI. Okay, I'm repeating it. Currency futures are regulated both by RBI and SEBI, not just only by SEBI here. Because since it has to deal with the currency, if there is little bit of appreciation, depreciation, and all that factors there, RBI also comes into the picture from the Indian context. Okay. Let's quickly go here. Okay. So lot of the other stuff was very, very, very common with the currency futures. In terms of again the forward future option, etc. These are all very, very common here. But what we wanted to do today is understand a couple of differences between currency and the equity derivatives, especially from the exam point of perspective. Okay. Now, what did we talk about? The lot size in equity, right? There is no standard lot size in equity. Lot size is actually determined by the exchanges. Okay. For example, Reliance has 500. Some other stock can have 150, some other stock can have 255, some other stock can have 365, etc. and all, right? Lot sizes in equity actually differ a lot. Okay. But in the case of currencies, the lot size is pretty much standard. The lot size is 1000. Okay. You can take a note of that, because this is very, very important. We will do more numericals. When we have to calculate the lot sizes, generally, in the exam, he won't give you the lot sizes there. He will just say that like, USD, INR, JPY, etc. and all, and just calculate this. In that instances, we have to, keep it in mind. For the currency derivatives, whatever it is, the lot size, is equals to 1000. Okay. Now, one more very interesting, thing. What did we say about tick size in equity derivatives? What is the tick size? Tick size is the minimum movement allowed in the price. Okay. The tick size, in the equity derivatives is, 5 paisa, right? In the case of, currency derivatives, please also you can take a note here. It is 0.0025. Okay. What do I mean by that? For example, like, if the price is 83, 1, 2, 3, 4, the price will move 82.9975 or 83.0025. This is how the price moves in the currency derivatives market. Got it? The tick price in equity derivatives is 5 paisa, but whereas the tick price, in the currency derivatives is 0.0025. This is the most important significant change. And the lot size is equals to 1000 in currency derivatives. These two has to be remembered. Okay. Most of the times in numericals, they won't give you this. Both on the tick sizes and as well as the lot sizes, you have to remember this. And this again a very sometimes they generally directly ask you that as a one more question as well. Okay. Now quickly moving on. I told you about base currency, quotation currency, currency features of. Now, let's look into a couple of things here. Yeah, please go to my PPT. Okay. Here, okay. Let's actually come to this here, or maybe we'll cover it here, right? We spoke about tick size, etc. and all. Now, this is one interesting concept. Again, people will get confused in the exam. I'm purely talking only from the exam perspective, right? What did we discuss just now? The contract size, especially is 1,000. You have to multiply with 1,000 with anything. With the USD INR pair, the contract size is 1,000. Euro INR, which is 1,000. GBP INR, which is pound INR, which is again like 1,000. The only difference is, N is little tricky. Okay, but let me tell you that you won't get many questions on N. I think you hardly get. If you are unlucky, you might get a question on NINR, in the exam. Okay, but in the case of the NINR, the contract size equals to 1 lakh. Okay, please note that. So, how do we arrive at the contract value? For example, like if the USD INR, what is happening here? Let's quickly look into this because the market is live, should be live. 95.37, right? So, what will be my contract value? 1,000 times 95.37. Okay. Similarly, you can calculate 1,000 times, whatever is the trade price with euro, pound, and then but whereas in the case of, N, it is 1 lakh times the trade price. Okay, which is the most important thing that you need to keep it right. Okay. One other interesting question, which is very, very, which these guys like is the mode of the settlement. I think people are coming, they're not able to see it. Okay. The mode of the settlement, especially, in the currency futures is always settled in Indian rupees. Please, 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 please note that. Okay. Whatever you are doing, right? At the end of the day, the settlement actually happens in Indian rupees. This is a very interesting question again for the exam perspective. Okay. So how we are studying this is, I'm drawing parallels to, we have set a foundation of what is happens with futures, and we are studying similar thing in currency, and we will study similar thing in interest. So that's like, where you can actually knock off everything rather than you studying from basics again, across multiple, not study equity whole book once, currency book once, interest rate book once. We're studying by theme, that's what it is. Okay. Now, the one and other interesting question, which is very, very important, is on the expiry part. Okay. This is again a very favorite question, especially for the exam point of view. What did we say about equity derivatives? In the equity derivatives, the expiry happens on the last Tuesday of every month. Okay. Here, please note, what I have written here. The expiry, the weekly contracts, generally expired on every Friday at 12:30. Okay. But the monthly expiry, what actually happens is, for example, okay, to study that, right? Now, monthly contracts expire 2 working days before the last business. Okay, let me tell you this because there are a couple of numerical questions or like some little bit of tricky questions that will come here. Okay, people, NISM feels, they wanted to, trick the students, etc. and all. There will be like 1 or 2 questions, that might come here, right? Understand this here a little bit, right? So if you see everyone, July 31st is Friday. If you look into your calendar, right? So when is going to be the expiry of currency, futures for the month of July? It will expire, 2 working days before the last business day. The last business day is Friday. So the contract will expire on 29th, which is Wednesday at 12:30 p.m. Understood, everyone? Please check your calendar. July 31st is the last working day, for this month. July 31st is Friday, which is the last working day, business day. So it will expire 2 working days before, exactly at 12:30 p.m. Okay. Sometimes they will ask you, there is this XYZ day. When does this expire? There will be at least 1 or 2 questions from this for sure. Because NISM feels that the exam feels that this is little tricky and they wanted to trick the students. Okay, understood, right? Go back and check July 31st. The expire happens on July 29th at 12:30. Okay, that is a very key important point. Okay, cool. Okay, we can wrap here for today because whatever I wanted to cover, I was able to cover. Okay, let me quickly cover this quick couple of stuff as well, right? See, the same thing applies here, right? The typical forwards, futures, the same whole concepts apply in the currency derivatives. You need not study again. Whatever I am discussing here, if you're able to understand that, that is sort of like more than sufficient for now. Okay, cool. We have 4 minutes left. More than happy to take any questions, concerns. Then we will pick it up from there.
Yeah, in futures, rollover contracts also important. The term was missed out actually.
Yes.
Just a typical one, just August. Can you explain the expiry for August? Because there's a Sunday
Okay, good.
and Saturday also.
That's a very good question, sir. I think you cracked that, right? Okay, guys, look into August, right? What is the last working? Sorry, what is the last working day in the month of August?
31st.
31st, right? Yeah. So you need to. Yes, Monday, right? I'm also checking it, right? So 2 working days before. So, like, what will be that day?
26th August.
Is the 27th, 12:30 is the going to be the
27, right? 2 working days. 31st is the last working day. So 28th and 27th. 27th August 12:30 p.m. is when the contracts expire. Someone got it, exactly correct. Most of you also said that. So 27th August 12:30 is when the contracts do get expired. Okay, any other questions?
Yeah, that's great. Kiran, just wanted to know where can we get these slides which you are teaching and the recording if I want to revisit?
Yeah, recording I know. I will put it in the group. Slides also I'll put it in the group. Don't worry. Just give me until tomorrow morning, please. Yeah.
Fine.
So today, what we have done is we are done with chapter 3 equity derivatives completely. We have started with chapter 3 currency derivatives. I think we have covered almost like 70-80% of that as well. There are only few concepts that are out there, because there is most of the overlap between equity and currency. I think we covered the base currency, quotation currency, USD INR, like what is the contract value 1000, the tick value which is 0.0025. When is the expiry that is going to happen. So these are the only important concepts there. Okay, you don't worry about that. There is little bit of a complication that comes from next week onwards when we start options. Options equity is little tricky, right? Because they will ask you about ITM, OTM, ATM. What is this whole concepts all about. Similarly, in the currency part, they will talk about depreciation. We have to concentrate a lot more. This chapter 3 here and this chapter 3 in the currency is more of theoretical, and I think we have covered most of the concepts. Okay, I think if you're able to follow this and if you're able to revise the PPT, and I will also tell you one key point here, right? When you look into the PPT, I will also give you the notes. Read line by line. Okay, please read line by line, because it's not like we have dumped a lot of stuff there. Every line is a question for you. Okay, every line is a question, because again, going back, right? The very famous question is, we might feel, okay, hey, what is this? But like, very important question is, who do you think the traders are, speculators are? This is a very famous question. They're risk takers. Okay, that like you please read whatever we are giving in the PPT line by line, and every line is a question. Okay. If you're able to do that, I think you will be able to cover most of the stuff. Okay. Yeah, I will put PPT on the group as well, sir. Please, yeah, that's what I'm saying. Any other questions, guys? Now we can wrap up today. Thoughts, concepts? Is it fast? Okay, were you able to understand?
Yeah, always in the currencies, questions are completely going to be asked in the based on the base currency, not for the quotation currency. Always it will be
That's correct.
base currency only.
That's correct. That's a good one. Yes, that's correct. So when we do the questions, sir, we will do that. Primarily, that's a very good point. And please kindly note that. I think that's a good point. Whatever the questions are asked, the questions are always against the base currency. Okay. And also the depreciation is also based on the base currency only. We will learn that. That is a very important point. Thanks for that.
Yeah.
Any other stuff?
Actually, there is some other questions are there, but it is not related right now. Just I'll ask in future, no problem.
Okay, perfect, good. Okay.
Because the open interest in the currency futures are completely different from the normal equity derivatives, because it is going to be maintained in the international platform, so that the ECNR guys only going to be the platforms only having the somewhat 80 to 90% accurate, remaining the